Welcome to Module 5, Section 8, where I cover a topic known as InterMarket Analysis.
InterMarket Analysis is a discipline made popular by a gentleman named John Murphy. He's written a few books about this. If you've watched my other videos, you've probably run across another book written by the same author that has to do with technical analysis. He also has written a couple of books on intermarket analysis. One that's a little more recent is Trading with Intermarket Analysis. These are not cheap books. If you like Kindle books, some of them are available in the Kindle format. Some of them don't get really high ratings on Amazon because people tend to look for magic answers, and when they realize there's work behind it that's involved, they don't really end up liking that book very much. Both of these books are a bit outdated, but they're still very useful, and this is a discipline that I implement heavily. Another book that's also outdated, it first came out in 1990, and there was a little bit of a revised version that came out in about 2013, but most of the book refers to things that have already happened long ago. But I still would recommend this book. It's a lot more thorough than the John Murphy books. It's Intermarket Analysis and Investing by Michael E.S. Gayed. I think that's how you say his name. If that's not, please forgive me. One of the things that we try to measure with intermarket analysis is what is the feeling in the markets right now? Is everybody happy and looking to get in because things are going up? Or is everybody unhappy and we're really going down and so people are sad? We can gauge these things in different ways, and that gives us some different insight as to what is happening. What you see in front of you is a freely available chart that's updated every day. It's put out by CNN Money. This is a gauge a lot like a speedometer. When it goes all the way to the left, we are experiencing fear. When it goes all the way to the right, we are experiencing greed. What I find a little more valuable is the chart down below. It takes a lot of different factors and puts them together and measures the overall fear or greed situation currently in the markets. I update this every day in the videos that I do. When we get to extremes, that's when we really take notice of this chart. When we get above about 80, now we're into extreme greed territory, and we're looking for things to reverse. Most market participants really don't know what they're doing. They tend to follow the crowd, and the crowd is usually wrong. The opposite of that is also true. When we see a lot of fear in the markets, and this particular chart really starts to drop, we get to a point where the fear is so heavy that now we're looking at getting in as a possible buying opportunity. We use this as a contrary indicator. Most of the time, this chart will maintain itself within the white area. We get a general idea of where it's headed, but we really only pay attention to this when it's hitting the extreme green area on the top or the extreme red area on the bottom. I added these colors myself. You won't find these colors on the chart if you go to the website to see this information. What is intermarket analysis? It is a branch of technical analysis, which means looking at charts, that examines the correlations or relationships between four different major asset classes. When we get involved in the stock market, a lot of times we just look at the stock market. We're not worried about other markets out there. It can be really to our benefit to look at those other markets. We may not have investments in different areas. Different markets can have an influence on the stock market, either positive or negative. Some of these major asset classes include stocks, of course. We look at a lot of different things just within the stock market, and we look at relationships. We also look at bonds. Sometimes stocks and bonds move together. Other times they decouple with each other and they move in opposite directions. It just depends on what part of the business cycle we are in. We look at commodities, and really this is just a look at inflation. If commodity prices are going up, there's a tendency for more inflation to be in the economy. If prices are really going down, we might be either seeing deflation, which doesn't happen very often but is very bad, or we just may see a contraction in prices and inflation is under control. We look at different currencies. We look at the US dollar, we look at the euro. Those are the two main players in the world right now. But we also look at the Japanese yen, we might look at the Swiss franc, a lot of different currencies. Technical analysis can use these relationships to identify the stage of the business cycle that we're in and improve our forecasting abilities. Different times during the economic and business cycle, stocks behave in a different way. Just as an example, as I record this, the tech stocks are really taking a hit right now. Different growth stocks are seeing a real selling process going on as investors switch from growth stocks over to value stocks. Most of the time, they like growth stocks because they want those capital gains. Other times, when there's fear on the horizon, people switch from growth stocks into those companies that have more perceived value, and they're seen as safer investments. This can change over a period of time, and so we watch for that, and that gives us insight as to what is happening. There are clear relationships between stocks and bonds and commodities and the dollar. So we look at all of these different markets, and we look at some things inside of these markets every day and every week. Knowing these relationships can help those of us that use charts to determine the stage of the investing cycle. Just like every year there are 4 seasons, the stock market goes through seasons as well. There's a time when things die in the winter, there's a time for new growth in the spring, there's the really hot time in the summer, and then there's the winding down time in the fall. We need to know what season are we in at any given time so we can make better decisions. If you want to find out more about this, I would really recommend going to stockcharts.com. Even if you don't have an account with them, there's a whole section on InterMarket Analysis that you might find helpful. Some of the information is a little bit old now. The theories and the concepts that are taught as part of InterMarket Analysis don't go out of style. We also have to deal with fluidity and fixation. Where is money flowing these days? What is the market fixated on these days? It changes all the time. The financial markets are always fixated on something. Right now, we see a real relationship between interest rates going up and tech stocks going down. That really hasn't happened much before. But it's happening now, and they're talking about it in the financial media. A lot of blogs are talking about that. I've noticed that. So we look for those relationships, and that can give us some good information. What the markets are fixated on changes all the time, and that's part of my job. That's why I do the daily videos and the weekly videos. I really try to tune in to what is the market really worried about right now? What are they focused on? Next week, it might be something different. Last week, it was something different. But right now, what is happening? This can change quickly, and it can also include reaction or overreaction in a market other than the U.S. stock market. It might be the bond market. It might be the commodities market. It might be some of the stimulus packages that are being thrown out right now, both by Congress and by the Federal Reserve. It could be price movement in another market. We may see stock prices really falling, and we don't know why. Well, we look at a different market and we go, oh, something's really happening in that market, and it's influencing how the stock market is reacting. There are geopolitical events that can happen, not only inside the U.S., but outside the U.S. What is happening between the U.S. and different countries? Japan, Russia, Germany, the EU, China. We need to pay attention to these things because they can have an influence on the markets. Back in 2016, there was a short-term impact on the markets because of Brexit. That happened in Britain. Didn't really even affect the U.S. to a large degree, at least for everyday average Americans, but the market reacted to that. Now, it was able to quickly recover and then move back in the uptrend that it was in, but these things can happen and will have either a short to intermediate term impact on what is happening in the stock market. Different surprises. The markets don't like to be caught off guard. They like to think that they know everything that's going on. If something comes flying out of left field, that really surprises the markets. I just talked about Brexit. That was a surprise to the markets. The 2016 election was a surprise to the markets, and it usually is short-term. As markets readjust and they have new realities that they have to deal with, then we usually will go back to the overall bigger trend that we were experiencing before that. Just to give you another example, in the spring of 2001, we were going down. We had already started a bear market in the U.S. We saw the dot-com bust happening. The markets were going down. Things were not looking very good. And then, boom, we got hit with 9/11. That was a complete surprise. And the markets, of course, after being closed for a week, really reacted to that. And that went on for a period of time. The economy really suffered. Things really went down. And it wasn't until 2003 until we really bottomed. And then we're able to turn and go back up. So sometimes these things can last an extended period of time. The whole COVID thing seemed to get the markets off guard. Right before everything started to be locked down, the U.S. markets were doing great. Then, when the pandemic hit, the markets tanked. Everything really looked bad for a while, but then it quickly recovered because of the stimulus and low interest rates in the economy, and now the stock market has been able to regain its upward trend. Uncertainty. The markets do not like uncertainty. When in doubt, do nothing. And that's what a lot of the big players will do. That's usually what I do. If I don't really know what's going on, I may just wait a little while to watch things unfold and then play that however it goes. The SPX investing program, which is the program that I offer, analyzes and comments to its members. I don't put these videos on YouTube when they're brand new. I usually put them up on YouTube after the fact because this is time-sensitive information. So this is only available to members of the program. I use InterMarket Analysis in the daily videos that I do and in the weekly videos that I do, as well as in the monthly videos that I do. What are some of the other markets that are analyzed? The SPX investing program, or the videos that I do, look at many different markets in the context of how they can impact the S&P 500, which I just referred to here as the SPX. That's the main vehicle that I teach and that I use for all of the strategies that I implement. I'm not out there trying to find individual stocks. I'm basing everything on the S&P 500 because there are more than enough opportunities than you'll ever have money to do. My main concern is how are all of these things going to impact the S&P 500? Some of these markets that we watch include other indexes. There's the DJX, which is the Dow. Those are the 30 blue chip companies that usually gets the most press. There's the NDX, which is the NASDAQ 100. There's the Russell 2000 and the small cap index that I follow. These are smaller stocks, and we know the relationships between smaller stocks and bigger stocks, and we can use that in our analysis. Also, mid-cap stocks. So I look at all of these things every day and I talk about them in my videos. We also look at foreign indexes, what's going on in other countries, as well as domestic indexes. The interrelationships between these different indexes. When small stocks are going up, that's usually pretty healthy for the bigger market. When small stocks are going down, that's usually negative. We also watch the mid-caps. We watch all the different sectors to see how is that going to influence the S&P 500. I look heavily at the bond market, even though I don't directly trade or invest in it, but I need to keep an eye on interest rates and bond prices and what's happening with the debt, not only for the U.S. government, but also with corporate bonds as well. I look at foreign bonds and interest rates, as well as domestic bonds and interest rates. Different commodities, which can lead to an inflationary environment if the price of commodities is really going up. Mainly, I just watch the CRB index. That's the Commodity Research Bureau Index. It's a basket of different commodities that are all crammed together. They use a methodology for calculating that index, and I keep a pretty close eye on that. I look at oil prices. This may seem really strange, but over the last few years, as oil prices would go up, that's helped the stock market go up. But then we saw a decoupling, where the stock market was shooting to the stratosphere, oil prices were really going down. So sometimes they move in tandem with each other, other times they don't. I also look at precious metals, specifically gold. That's a really good benchmark for gauging different fear and inflationary concerns. So mainly gold and oil are the two different markets that I tend to look at the most. I also really look at the dollar index. With all of these stimulus packages, with all of this quantitative easing, with all of these other things that are going on, with this money being pumped into the U.S. economy, what in the world is that going to do to the dollar? If you have a lot of dollars out there, that tends to decrease the value. If you have fewer dollars out there, the dollar will increase in value. Well, with this just flood of unprecedented liquidity into the market and people receiving stimulus checks, all this money going into the bond market, which eventually a lot of that can work its way over to the stock market, what's that going to do? So I keep a real close eye on the dollar index.
This concludes Module 5, Section 8, and I'll pick up with things again in Section 9.